Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media. I'll interject my financial opinions, generally related to wealth building, commodities, and or financial topics. So let's dive in here. Let's take a look and see what people are sharing, and I'll give you guys my comments. If you want to follow me at Finding_Finance, and if you want to join our community, finding-value.com, where I dive deeper into sectors, companies, and look for those 10, 20 baggers that are out there. So I'm going to start with Kevin Bambro. I guess he or I, or whatever you want to say it, we have very similar approaches. So this is what he says, and this is, I think, very true. This is Greenland Resources Molly update. He says, sometimes investments take patience. I've been long this company since pre-IPO and grew my position to around 5 million shares with market purchases such that I'm flat to down on it today across RRSP, etc. He says, nevertheless, I'm a big believer that there will be a big shortage of molybdenum emerging in Europe, and the price will be more than double today's price. The Moly project in Greenland will prove to be one of the best investments I've ever made. But these things take time. Permits and market conditions need to be waited for. When you load up on the stock, you think it will 20x winners. Sometimes it takes 5 to 10 years for that to occur. That's my style. This post is just to address the criticism I get from anonymous cowards from time to time. He adopts basically the same approach that I do, and that's to find these setups like he just did with Molly, in his opinion there, take a position, and then be patient and wait for it to materialize. He says it's frustrating enough to see setbacks and watch profits evaporate or major investments turn into losses. Sometimes politics play into it, other times major mining problems or labor disputes or even fraud. Things go wrong in the junior mining sector. There's huge reward when you bet that a company will a risky political environment will improve. But there's also massive punishment when it doesn't. See Niger as an example of this, and the struggles Glow and Eel are facing. I got whacked on both, but things can also improve. The big bets that save people should be the ETFs, URNM, URNJ, etc. But they will never perform like gambling like I did on PDN when it was under 8 cents and risking bankruptcy. Again, if the market didn't turn at that moment, so now it's up 10x to 1.6 plus on reverse split adjusted basis. The big calls make you big money, and you with decide to dedicate yourself to them or find a different style. Buying stocks that have had 10x or 20x runs isn't my style. I like to buy and own stocks that I think are going to make 10 to 20 times my money, and that requires research and dedication. The commodity markets are my favorite place to find excellent bets on a 5 to 10 year basis because good deposits are always going to be good deposits. They are permanent call options on the underlying commodity. The call option value Molly has a molybdenum is unparalleled. Consider the cost of trying to buy long-term option in the copper market via futures or options. Do the math and digest how expensive it is to try to get a massive return 5 to 10 years out on a move to $8 to $10 per pound copper. Consider that if try to bet on the next couple of years for more torque and you're wrong, the options become worthless or the futures could destroy you in a downturn. Then consider the fact that although there will be dilutions to keep junior afloat, buying the right juniors in a given sector will give you massive leverage to the commodity price. And even if you're wrong by several years, you still can get massively paid for waiting, even going fishing. Some commodities like molybdenum are extremely difficult to even get direct commodity exposure and make big bets. The storage cost of the material relative to value is too high. Do the work, look at the option value you obtain in various junior resource companies, and then place your bets if you desire. But understand the bets you are making, and please don't come back and insult me over and over again when some investments don't work or some themes take longer than you think to play out. I'm in Greenland Resource to see the permitting process, through which I believe will be done as a project is massively important to the local and national economy of Greenland. I'm also in the company until moly price blows out and Europe in a panic and the big steel companies are competing to take over Greenland resources. I believe strongly this will happen and it's a 20x potential, which means I can make a boatload of money if 5 million shares go to $4 or $5 a share, and that's just a 10x. So that's his opinions there. Coming back to the main, and we have very similar investment approaches there. Dr. Leah, MS published oil update aptly calling the market distinctly mixed, but shifting the skew to the upside with upward demand revisions and seasonal Q3 draws of 2 million barrels per day for crude only. We've got the Kobayashi letter. It says further evidence that inflation is accelerating. U.S. labor costs in the last quarter rose by most since Q1 2023. The Employment Cost Index is a broad measure of labor costs closely watched by the Fed. The index surged 1.2% in Q1 2024 after a 0.9% increase in Q4 of 2023. Labor costs are rising at a comparable pace to mid-2022 when inflation in the U.S. was above 9%. So U.S. employment costs and job openings, the cost index is rising at the same time that the right axis, the dark gray, is non-farm job openings. A little bit of an alligator mouth opening there. Got gas. U.S. gas surplus will be eliminated before end of winter of 24-25, according to some data here. We've got NextGen. They're announcing a strategic purchase of 2.7 million pounds of uranium with an issuance of 250 million convertible debenture. Incredible. I don't know what they're doing, guys. I don't know why you'd be buying that, but maybe they're doing something I don't know. Coming down, RevCap, reliving the 1970s. Funny to see these parallels. And I'm going to go right into the parallels here. This Los Angeles Times, October 28th, 1979. It says, what we have is a new split in society. People who bought before inflation and those who bought after. The first group can sell their inflated houses and buy the $150,000 houses you see in Orange County. They're hurting, but they can survive. The second group, even with two incomes, will be outside pressing their noses against the glass. And that's kind of a similar situation we're in. The only thing is, we're not in 1979. We're earlier than that. And the reason I say we're earlier than 1979 was on the back end of two large bulges of demographic, which means we've got a lot more people going through home buying years in the early 70s and the late 70s. We had a housing crash in the middle of it where we produced too many homes too quickly. And then we had to go back into an expansion phase in the late 1970s. So that was at the tail end of the housing market when we were in a hypersupply phase. Right now, we're not in a hypersupply phase. We're short homes. We don't have the inventory. And we really need to ramp up home builds is where we're at. We're still at a 5 million home deficit, which just absolutely blows the 1970s out of the water. It's not even a fair comparison. In the 1920s, mid-1920s, before that 29 crash, that was another housing boom, and they were just giving out loans like they did in the 2000s. It was the same setup. We're not even close to that. We've got probably 5 years before that ends, or 3 years, or whatever it is. We have a long way to go. It might even be longer than that, because I don't think we can build that many homes that quickly. Commodity stocks have been the best investments for 4 years, with growing signs of continued outperformance. Over the past 4 years, stocks of commodity companies have outperformed tech stocks, and I know everybody thinks tech stocks are doing so great. During this period, the energy sector returned 199%, while the tech sector trailed 126%, and I am way up more than XLE is. I believe this is just the beginning, and many are still unaware that the commodities sector is the best performing sector in recent years. Commodity stocks thrive during inflationary periods. Although current inflation appears much lower than last year's, this perception may be misleading. Instead of directly comparing today's inflation to last year's, it should be viewed in a broader context of past economic cycles. A growing economy is inherently inflationary, while a cooling economy brings disinflation. The chart I'm sharing today shows a strong positive correlation between the ISM Prices Paid Index and the ISM Index. As prices rise, the ISM Index also increases, indicating that economic growth, as measured by the ISM Index, often coincides with inflation, as reflected by the ISM Prices Paid Index. The red dot on the graph marks the current moment and points out that inflation is very high at the current level of economic growth. It is likely that the US economy will enter a recession where inflation could be higher than in previous US recessions. Once the economy recovers, inflation could exceed that of the previous boom period, meaning it is likely to be a shock to see how high inflation will be. While I can't predict exactly when this will happen, I'm confident that by then, more people will see the value of commodity stocks. We are now only 4 years in, and in a few years, more people will realize commodities are the best performing sector. And there's the red dot. This is ISM prices paid, and this is your ISM headline index, the average of manufacturing goods and services. And we are kind of in a off towards the edge of where this data is accumulating on this linear regression analysis here. So these are the edges over here where they're paying more versus the ISM headline index. Let's go back to the post here. We've got, this is just not bullish and will cap the upside to crude this year, according to HFI research. And what I do is I look at to see what the trends are. What are the trends that we have of previous years? And we've been coming down, coming down, coming down. Yet we've got one that's up a little bit. Now, does this mean that we're going to stop drawing? It's one data point. I would just stay open. That's where I would be. It's like, it's one data point. Let's just see what occurs over the next few weeks, months. But obviously, it's not preferable to be going up and adding to inventory. We'll see. EIA, we've got week ending crude is drawn down minus 1.4 million barrels. Cushing added 1.9. Gasoline, about 1 million barrels, and distillate, about 500,000. Crude oil reversing earlier losses after the IEA reported a 1.4 million barrel draw, while gasoline and distillate stocks rose by less than expected. Production held steady at 13.1 million barrels per day, with export rising to 550,000 barrels per day. Gains held back by 1.9 million barrel increase at Cushing, and nearly a 1 million barrel going into SPR. Implied gasoline demand rose for the first time in 5 weeks, but the average 4 weeks still stays close to the 10-year seasonal low. So here's crude oil inventories, a little bit below the 5-year average. Motor gasoline total inventories coming up a little bit almost to the average. We've got Cushing crude oil inventories were low. Total U.S. refinery demand is up, and everything's looking pretty solid. Stagflation of VA, it says, we find stagflation narratives to be premature because one of 3 key components of the backdrop is high unemployment, clearly not present today. A second requirement is the slowing of economic growth, which is also somewhat ambiguous because GDP, after stripping out volatile trade and inventory, is relatively solid at 2.8%. Unless the labor market falters markedly, it will be difficult for stagflation to gain ground. So stagflation, he is not buying it in terms of Bank of America global research. At least not yet. We got to see unemployment kick up. Bears sound smart, bulls make money. Completely agree with that. It's really hard to be a bear. And bulls, it's much easier to make money. You just buy it and sit in it. There's been much talk about a pending recession again. Keep this in mind. This is from the economist Rudy Dornbusch. It says, it's known to have said that economic expansions do not die of old age. They are murdered. This has been true for the last 50 years. So 2020 had COVID. 2008, there was a financial crisis at $145 crude oil. In '01, we had a tech crash and 9/11. In 1991, Iraq invaded Kuwait, a 400% rise in crude. Actually, it was the 1990 housing market bubble there. And after the 1990 bubble, crude oil generally has a huge run. 1982, 200-year high in interest rates. 1980, 100-year high in inflation. And 1974 was the Arab oil embargo. A lot of these actually were housing real estate crashes. 74 was, 80 was, 90 was a real estate crash that caused the 91 crash. We had a pullback in housing in 2000, which also coincided with the tech crash. This was a housing market crash, and that's totally separate. So too many think the economy will either roll over or pop. It does not work that way. It does not die of old age. In a capitalist economy, investors, like most of those reading this, give money to good ideas and take it away from bad ideas. This means the economy continuously self-adjusts. So the natural state is to expand and grow 90% of the time. The other 10% of the time is a recession because something murders it. So all the talk about deficits and inflation will not cause a recession. However, these issues can and probably do make the economy vulnerable to murder. But it will still take that murder to cause a recession. Think of a pandemic, spiking crude oil, political crisis, all of the above simultaneously. This unexpected event or events could be later this year, in 10 years, or anywhere in between. It really cannot be predicted, like COVID, especially by economists. This is not a knock on economists. No amount of analysis of payroll numbers or inflation reports can tell you a pandemic, a spike in oil prices, or a political crisis is coming. How do we know when the murder has happened? Investors lose a lot of money. A recession means that even investors' good ideas act like bad ones. And that's what we've got from them. So he doesn't think that a recession occurs due to old age, which a lot of people are predicting with the yield curve and its inversion and how long that inversion has been. So I'm in the camp where, I look at it and I'm like, I can't predict a recession, and I don't think anyone else can either. So I think this is a really good opinion there. Game of Trades says this is very bullish for the markets. Break above rising channel, retest of the channel, and bullish momentum. The next leg up is incoming, in his opinion, for the S&P 500. And he's looking at the bullish momentum indicator and a potential retest if you use that trend line. Eric Nettle says energy remains an out of favor, non-consensus, contrarian investment. As a contrarian investor myself, I love it. The best opportunities are where no one else is looking. I agree with that. I say that all the time. Here's energy, and it's still down in the doldrums, even though it outperformed technology the past 4 years. Peru coming out of a 16-year base and making new all-time highs. What's the trade? New all-time high here for Peru breaking out. That looks really good. I like how the lows came up right into that resistance and then broke out. Beautiful looking chart pattern. Copy says, I've gotten a lot of questions about A-Mark earnings. You guys seriously need to do your own work. In summary, the quarter was roughly in line with my expectations. I knew it would be a rough quarter, and I noted that in my blog post. If you were shocked to learn that, then not sure what to say. The whole point of inflection investing is to buy an amazing business at an amazing price because the market is fixated on a bad print, looking backwards, as opposed to the inflection at play, looking forwards. CEO Greg Roberts was very clear in the earnings call that they've seen a material recovery in volumes and spreads in April and May. That's the inflection I'm focused on. Who cares what happened when gold and silver were range-bound and boring during calendar of quarter one? I think about to have a raging bull market in precious metals over the next few years, and A-Mark is how I plan to play it. By the way, It's bullish to see the recovery in the business lining up with the breakout in gold and what looks like an imminent breakout in silver. It's what you'd expect to see. Meanwhile, all sorts of ETFs like GLD, SLV, Fizz are showing outflows this year. I think this indicates where Western sentiments on metals are. Imagine how the A-Mark business does when FOMO and then fear take over and guys rush into the metals. It's hard to know when that happens, but I want to play that trend with A-Mark for when it does happen. I think we're still in the early innings of this metals cycle. There will be many good and bad quarters on the way to that moment. This will be a volatile shock. I accept that as a price of admission. You know what all of these good investors do? They focus on the long term of what's coming. They position themselves in a way to play what they think is coming. They take a long time horizon, 5 to 10 years, and then they wait and they wait patiently. And that is where everyone gets it wrong. And that's why Cuppy's responding to, oh, you guys seriously need to do your own work, because he's probably getting a lot of crap. Oh, it didn't work. Oh, the bad quarter. Oh, he's not playing the quarter. He's playing the 5 to 10 year move, just like Kevin was above us. That's how you invest. You don't invest looking at one bad quarter and then saying, oh my God, they've had a bad quarter. It's like, are they inflecting? What's coming in front of us? If the answer is it's still good and everything remains intact, you just stay long. And that's where everybody gets it wrong, because they're focused on the wrong time frame. They're not focused on a 5 to 10 year time frame to make major money. They're focused on the short-term time frames where they have crappy little, they're not even, they're like symmetric bets. And then you're not even playing the company. Like, there's no point in even looking at the company at that point, because the company doesn't matter. All you're playing on a short-term market basis is the sentiment. That's all you're playing. You're not playing a lick of the fundamentals of the company if you're holding less than 5 years. You only get a quarter release base on how the business is actually doing. So if you're holding less than a year, you're not playing the fundamentals at all. You're just playing market sentiment, and if it's in favor or out of favor. And then you're playing the technicals, which are just herd mentality, which is more or less you're trying to gauge what the sentiment of the market is. In order to play a really jacked up move in the market, like we've got a huge imbalance or something like that, you've got to take a longer time frame than a quarter or two. I mean, that's just way too small in my opinion. And that's what the value guys are actually extracting. They are extracting short-term market playing fools, is what I'll call it. And then we take your shares when the sentiment is bad. I stockpile them in the portfolio, and then I wait for sentiment to return to positive, and or I wait multiple positive and negative sentiment cycles where the fundamentals of the company and their earnings overpower the sentiment, where you get higher highs and higher lows. Those lows are the cycles of sentiment lows. The highs are cycle of sentiment highs. And the lows don't bring you back to where you purchased it originally. So you get this stair-step pattern up and up and up and up over time with some consolidations in between. That's your difference of short-term market sentiment. The problem that most people have, and I know I'm kind of just going off on a tangent here, but the problem that most people have is they take short-term price movements and dedicate and create a narrative to a long-term price move where they say, oh, well, it's not working. You don't go straight up. They don't understand the market. They're not seasoned. And that's the difference. Seasoned guys know that you're not going to get it right on a quarterly basis. Seasoned guys have all adopted the same time frame of 5 to 10 years. Seasoned guys take on positions to position themselves for something that is coming. That's the difference. You have a lot of people who don't know what the hell they're doing, and they're running around like a chicken with their head cut off, saying, oh my God, this last quarter, they missed earnings. It's the end of the world. It's like, guys, oh my God. Like, that's not why you invest in a company. It's because they might not they might not beat earnings every quarter in a big bull market that's 10 years. I mean, you're going to have to go through some volatility of maybe a missed quarter or two in a market a little slowdown on the way. That you can't predict, in my opinion. With an expected continuation of Saudi OPEC voluntary cuts into second half of 24, Eric sees global oil inventories falling to record low levels by the year end of 24, supportive of $90 Brent, in his opinion, with zero political risk. This chart puts into perspective how cheap oil prices are when adjusted for true inflation. Oil in gold terms is currently at one of its most undervalued levels in history. To reiterate, none of us own enough hard assets, and here is the historical cheap low. This is oil divided by gold. And you know what we have here on the right-hand side? Look real close. We've got a shoulder, a head, and a bottom of a shoulder in the ratio that could be coming here soon. And then we're going to break and go all the way to the upside because of the market conditions, because money rotating, it's coming. And that could also be from maybe we have problems with shale oil production, potentially. It's also going to be driven by too much credit in the system chasing too few of goods, in my opinion. And that's where I'm going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Mayday is the coupon code. If you'd like to save some money, we've got a 7 a.m. question and answer session coming up on Saturday. And that's all I've got, guys. So we'll catch you next time. This is Finding Value.